All right. Let me pull up a couple times today, guys. I'm going to ask you guys to participate inside of chat. And thanks to a multiple monitor setup, I can actually see, and I'm trying to get some feedback from you guys as we go through. So before we start, I will say I am an East Coaster. I do get very excited and passionate about this, so I do talk a little bit fast. I will try to slow myself down. I have my little post-it note. But if I talk quick today, just ask me to slow down and chat, and I'll do my best with it. All right? So with that said, let's just dive in. This is parabolic retracements is one of a number of strategies that I use on a regular basis. And for me, it's probably one of my favorites. It was something that I saw in charts all the time. And as Raleigh said, and I really appreciate that intro, one of the things that I try to do is help formulate and create strategies for people that are very specific in their lives. And what I mean by that is not everybody has 18 hours a day and, to sit in front of computers and listen to news and watch markets. And so I try to create things for people on the go because I myself am also in the same situation. So let me jump through here and before I dive in, let me go through our Natick's risk disclaimer real fast because it's important. I'm a very, very big focuser on risk, and I want you to understand these because I'm going to actually kind of come back to this a little bit later. So trading on Nadex involves financial risk and may not be appropriate for all investors. I'm very, very, that strikes right in my heart. And when I'm explaining this strategy, I'm going to explain exactly why I'm kind of covering this, right? So the information presented here is for information and education purposes only, and it's not an offer or solicitation to buy or sell a financial instrument or Nadex or elsewhere. Now, any trading decisions that you make are solely your responsibility. Just remember that one. Past performance is not necessarily indicative of future results, and Nadex contracts are based on underlying asset classes, including Forex, stock index futures, and commodity futures. Okay. This last one obviously is very, very important. Trading can be volatile and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures that investors cannot lose more than the cost to enter the transaction. Okay. That last paragraph is exactly why I do what I do. Okay. Trading can be volatile, absolutely, but we love volatility because with risk comes reward. Okay. If the markets were not volatile, it'd be very, very difficult to make money in the markets. And this strategy that I'm going to show you guys today is actually taking advantage of that volatility. Okay. We're going to kind of add like a different factor to it. So for those of you that don't actually know me, I know a bunch of you do. I've seen some comments and people shooting me messages. As Rolly said, I'm the CEO and president of Keep Trading Simple. Now, I always get asked this, you create strategies. Why do you do it? What else do you do? I create strategies because what I feel is you need to have multiple arrows in your quiver. If you think about when we go to our traditional schooling, I have, this is my little girl. She's not quite in school yet, but I have two twin boys that are 10. We don't go to school just to learn one thing. We don't go and just learn science. We learn science and social studies and math and, spelling and grammar and literature. So we need all of these things to become a more well-rounded person. Well, in trading, you should have many different strategies because depending on what's happening in the market, you may need to use strategy A and then at another time use strategy B and at another time strategy C. And the markets are constantly evolving. Okay, I've been trading since about 2000, so I've seen booms, busts, sideways, pretty much everything in the entire gambit. I did this from a retail trader perspective. Like my father was not a floor trader on the CME or anything like that, right? He was not an options trader, not a runner, none of those things. I started off like most people do. I was buying books, going to seminars, things like that, and I learned a whole lot of what not to do. Well, after doing this, and I started with traditional options and stocks, found foreign currencies, and again, I love the leverage. That was something new, being 24 hours a day. Found futures after that. Ended up becoming a financial advisor because I figured for me to take the next step, I needed to go on the inside, right? I mean, that would make sense. I mean, how many people out there right now, go ahead and type it in chat. How many people think if you became a financial advisor tomorrow, would you have the inside knowledge that just regular, Joes, out here that we can't get? Do you feel that you would get anything new that would make you a better trader? Because I did. And I found very fast that was not the case. So I left that industry and then came out. And my true passion is helping other people. And again, crafting things. Now, I will say one thing that I have learned over the last, about 20 years, probably about 10, 15 of coaching is I could give you guys, and I always laugh when I see, full strategies laid out for people is I could give you a strategy, but I can pretty much guarantee nobody will ever follow it 100% of the way. And the reason I say that is this. Think about when you get a recipe from somebody, or you get a recipe out of like a fancy magazine or off of YouTube or something, right? Do you ever change any of the spices just a little bit? So what we're going to talk about today is my parabolic retracement strategy, but I can tell you right now, everyone in this room will probably try to make it even better. And I challenge you with the knowledge I give you guys today, and I'm going to give you actually a free resource at the end as well. I challenge you to make my strategy better. Okay. I want you to make it better. Okay. Always try to push forward. And again, that's the most important thing about trading. So let's go over what we're going to talk about today, right? So first things first, I'm going to define what a parabolic move is. Again, we got to know what we're talking about to be able to have, to be able to trade it. Then I'm going to talk about why we trade the retracement. Okay. We're going to talk about when they can be traded because again, we're not sitting here all day. We have technology, we have calendars. We know exactly when these things are going to happen. It's very easy to figure out. So again, you can plan your day, trade your regular strategy, and add this in later on. Also, what assets could you use to trade this? Okay. And then, as the title said in the beginning, why would you choose an out-of-the-money contract? Now, an interesting thing about this strategy, this is a Nadex sponsored event. Nadex is one of the things that works absolutely amazing for this, but it's not the only thing that you could use. You could use it in current, you could use it in the Forex market. You could use it with futures. You could use it with stocks, traditional options. I really, really like it because I really like to get into the contract details of Nadex. Okay. So again, in today's kind of context of things, let's keep our Nadex thinking caps on, and I'll kind of cover how we would trade it in a bit. All right. So let me go down across to the next slide. Let's talk about a parabolic move, right? What is a parabolic move? And the easiest, most simplest way is what just happened, okay? And I want everybody to think about this right now. And again, if it's happened to you, go ahead and type it in chat, okay? Because again, this is a community. We're all a community together, right? Have you ever been looking at a chart and all of a sudden a candle just explodes, goes right through down to the top of the chart, and you're sitting there looking at this going, my God, what's happening? Is my machine broken? Or vice versa, you saw something, you got, earnings or some type of good news came out, price exploded and you bought it right away because, hey, listen, everything's good. And it turned around and went right against you right away. And you're like, what just happened? The earnings were good. Why is it going the opposite direction? What happened? Right? That's what a parabolic move is. And by definition, okay, a parabolic move is an explosive one-directional move in an asset that is exponentially greater than the average move during that time frame. It'll often look like panic buying or selling and is most times associated with a major event like earnings or an economical news release. Now, I always get asked, how would I define an exponentially greater than average move during a time frame? Well, if you guys know me, I am in the personal belief, and again, there are many other people that agree with me. There's a tool that pretty much every charting platform in the world has called ATR, average true range. Okay? What it does is it gives us the ability to look at what an average move during a specific time period looks like, right? Well, the way that I define an exponentially greater move is if it's over 1.5 times what the ATR is, that's what I would consider a parabolic move. Okay. It's just a very, very large, again, a very large push in a very short period of time. And we've all seen it before. And again, if you guys have an example of a parabolic move that you've seen recently, go ahead and type it in chat. I'd love to see what other people are seeing out there. Again, I get as much feedback from you guys as you get from me. So what does a parabolic move look like? Like this, right? Now, I'm sure you guys can see the numbers here and figure out what this asset is. But the way, I'm a price action trader. I read price action. I don't really care what the asset is. And the strategy is not bound towards just a specific asset. It's based off of fear and greed inside of the markets, right? In looking at this, what do you think caused that enormous green-bodied candle? Do you think it was the fact that maybe the market opened, or maybe that, say, something like, I don't know, Apple earnings were great, or unemployment, or the unemployment rate dropped down to 3.5. I don't know what it was, but I know at that point in time something happened that caused an emotional reaction in the market, to send that thing flying definitely over 1.5 times what the average candle body is. Okay. So in this case, we were able to get a parabolic retracement of 200 plus points in under 60 minutes. Now think about that. How many times a day could you say, hey, listen, I just took 200 points in? You guys can figure out what this asset is. I'm not going to tell you, right? How often are you getting 200 points in 60 minutes, right? It doesn't happen all the time. And again, that's just one here. I mean, here's two additional examples. These are over in the currency market because, again, people talk about the currency market being more volatile and everything else. And, one thing that I didn't mean to mention on the last slide that I didn't is my belief right now, and again, this is very important. This is not to take away from anybody else or anything else that anybody's beliefs are. Right now, we are what I would call a trader's market, not a swing market, not an investor's market. It is a trader's market. Okay, what do I mean by that? I mean that if you look at, maybe in 24 hours, how much did an individual asset move, particularly currencies? Sometimes it comes back at almost nothing. But if you look at the chart, these are the kind of things that we see. We see large movement up, and what does it do? It retraces back. So if you're just holding something, you're waiting for this trade to last days and days and days and days, it's not happening. But there are many, many, many intraday movements that we can profit from. Okay, so these are two other examples. One was a burst up in the euro dollar. The other was a collapse in the pound yen. And again, it doesn't necessarily matter what the assets are. Obviously, the last one was not a currency. And again, you guys know what that one was. These were currencies. It could be oil. Has anybody in this room ever, and again, give me a yes inside of chat, has anyone in here ever looked at an oil chart and saw an out of the blue sudden explosion up or down, particularly around something like maybe oil inventory reports that happen every single Wednesday? What about an OPEC report? Do those happen anytime? Yeah. Yeah, these things happen all the time. So again, these types of things happen all the time. Now, this is the question that I get asked all the time. Because everybody sees this. The first question that pops in their head is this. Why would I trade the retracement? Why don't I just trade the news? And that's an absolutely excellent question. And here's why. First off, I told you guys that I have many arrows in the quiver, right? Do I have a news breakout strategy? And the answer is absolutely yes. But, do I know exactly where it's going to move? No, right? When I do see the move, meaning that the news comes out and the news is wrong and there's a large explosion in price, do I know that the setup is definitely there? Yes. Yes. Which one would I rather do? Would I rather place the trade when I know the setup is already occurring, or would I rather place a trade when I hope the setup happens? Right? I like the confirmation that we definitely have the environment for the retracement. And again, what does it prey on? Okay. Going back to the disclaimer, and the reason I read it is we talk about how the markets are volatile and people risk losing money. Think about what happened, right? Many, many people react to something like a retracement, right? They look at news and say, oh, I think that, that's good. I should buy it. And then it immediately goes against them because all the people that were smart, that knew things ahead of time and, that placed these kind of riskier trades in the beginning, they are selling it to you, right? If the news was so great, why would anybody in their right mind sell it? They're trying to take profit is what they're doing. And you're buying it from them and then it goes back down again. All right. So the reason why we trade the retracement is because we know the setup has occurred and it helps us define our risk, keep our risk much, much lower. Because at the end of the day, that's what's most important is being able to control risk. All right. Hopefully that makes sense why we trade the retracement. It's not that we can't trade the news, and again, we can, but it is not necessarily as high of a probability trading strategy as trading the retracement. Okay, because one of them is, like I said, one of them is preying upon that fear and greed. The other one is hoping that something's going to change with this fear and greed. Now you may say, all right, so, I guess that kind of makes sense, right? But what causes those moves? And again, this is just one example, okay? What I'm showing you right now is an economic news calendar. There's many different websites out there that show you these things. Daily FX, Forex Factory. Those are probably the two biggest ones. But I mentioned before that I'm not a person. I don't like sitting in front of the computer all day. Well, if you have a busy schedule or you work full time or maybe, your trading days are Monday, Wednesday, and Friday, you can go in, look at an economic calendar and see, again, when is there going to be a high impact news release? What's the forecast? And then again, what is the actual? So just kind of how Mark said, he had he has an alert to let him know every Monday morning that it's time to kind of go in there and check that one strategy. It's kind of the same thing. You can say, hey, listen, I need to go in there. I'm looking for trades. I have this new strategy I want to try out. When could I go? When is the highest probable time that one of these setups is going to occur? And you can dive right in. Now, all news releases are not created equal, just so you guys know. Just because it says red high does not mean that it is a parabolic retracement setup. Okay. Could it? I guess it could, but there are some that end up triggering and are better than others. I mean, if you think about it here, if there's a, say, GDP report for the United States, do you think that that has a high probability of moving things like the indices and the dollar and gold and oil? Yeah. What about Germany? If Germany has something, is it probably going to move the U.S. indices? No. Is it going to move oil? Maybe a little bit. So there are certain things that will move more based off of which country they're coming out of, what type of release they are. And again, this is where kind of you can really dial this strategy down to match your individual style. Now, big question too is when can they be traded? And again, I just talked about different news releases, but it's important to understand when the biggest market movement is. Now, the reason why I don't sit in front of a computer all day is because this. I mean, what happens every day pretty much in New York, and again, if you've never been in New York, I've been there, I've worked, a block and a half from, the stock exchange. What happens between 12 and 1 pretty much every day? People go out and they eat lunch. There's not a lot of movement. It's like watching paint dry. So the reason I have native Forex hours up here is it's because, again, the world is a global economy, and why this is important. And again, a lot of people will see this and be like, I don't care about Forex. You should, right? Because again, there are certain correlations between currencies and commodities. Like think about it right now. What do we have going on right now that, at least in my lifetime, I've never seen a global pandemic, to the level that we are right now, right? A lot of countries are printing money right now. Gold has, been going higher, higher, and higher. Why? Because of inflation. And guess what that has done to the Aussie? It's also made it higher because, again, it is a proxy for things like gold. So understanding when New York hours are and when Tokyo hours are and when Sydney and London hours are extremely important. Now, when is the ideal time to be able to trade parabolic retracements? Okay. Well, most economic news releases that, again, they are different every single week, so there is not one specific time, occur in these overlap sessions. Okay. The biggest overlap section is between like 8 and I would say not even so much 12 as it's on the slide. I would say really between 8 and 10:30ish. Most US based releases happen between 8:30 and 10:30 in the morning. The exception to that is FOMC notes. Okay. Those are typically Wednesdays at 2 p.m. And again, can FOMC, the Fed, you guys have heard the Fed, right? Can the Fed really change the trajectory of the market? And the answer is absolutely, right? Because, I mean, they control monetary policy. But, again, most releases happen between 8:30 and 10. The reason why this is my absolute favorite overlap session is because, again, my personal, and again, this is kind of one of those funny things. How many times have you guys in the audience right now, how many guys and girls, how many times have you ever asked an educator, what is the best time to trade during the day? Right? What is the best time to trade? If you guys would like to know what the best time of day to trade is, if I could give you a half hour to 45-minute window, is that something that you guys would be interested in? If you want to know, go ahead and ask that inside of chat. Okay? Ask me what is the best time. If you guys already know, don't worry about it. I won't waste my time. But I'm curious to see how many people would like to know. But this is my favorite window. Second one is that Sydney to Tokyo time frame, the 7 to 2 p.m. Now, or 2 a.m. I wouldn't say that that is probably the ideal situation, but I'll tell you right now, many people in the United States believe that we can only trade from really 8:30 in the morning till 4, and then that's it. There's no more opportunity that exists. If that is your belief, and I don't mean to offend anybody by this, if that is your belief, you're doing it wrong. Okay? One of the absolute best opportunities almost every single day to trade is at 9:30 p.m. Eastern Standard Time. Yep, I said that. 9:30 p.m. Eastern Standard Time. and particularly with parabolic retracements. And the reason why is because that's when all of Australia's economic data comes out. Do we have the US markets and dollar messing it up? Nope. It's purely an Australian play. So it's very, very clean. There's not a lot of distractions. It's easy. I mean, how many people would like to place a trade right before you go to bed, right? That's pretty cool being able to do that. And again, that's why the session overlaps matter. Now, also that 3 a.m. to 4 a.m. in the morning is also an extremely, there are boundless opportunities at the European Open, right? That London UK Open, because again, that's when technically the day starts on the global, basically London is like New York. In the stock market, New York is the most important session because again, that's where kind of the heart of the, the financial, industry exists, right? Now, on a global level, it's London, right? It's London. Those are some great opportunities. Now, I don't trade it too often in all transparency. I stay quite busy with my kids and everything else. Waking up at 3 o'clock in the morning, I'd be a zombie, right? Now, if you're West Coast of the United States, it's not bad. It's midnight for you. I have many students that do it. Some of my students in Texas are always trading. They're trying to stay up and trade the big releases for that one. When I was younger, I used to do that more often, but I don't do it as much. So for me, I primarily focus particularly with parabolic retracements at 9:30 p.m. at night and then the 8:30 to 10:30. So it looks like a lot of you have asked what the best time to trade is, and here I'm going to tell you. Okay. If I had to pick, I'll even dial it down. The best half hour in the entire 24 hours a day that you could trade would be from 10 to 10:30 in the morning, and that's it. Okay. Almost every single day, and you guys can ask my students. There's many of them in the chat right now. Every single day, there's typically 2 to 3 different setups that occur at 10 a.m. in the morning. Here's why. Okay. Most U.S. economic news releases happen at 8:30 in the morning. Well, you guys know what time retail traders come online, right? The market opens at 9:30. So in that time frame from the economic news releases, the retail traders are trying to prepare themselves for the trading day. The first basically half hour to 45 minutes every single day has nothing to do with banks, institutions, hedge funds. It has to do purely with retail traders. Okay? Purely retail traders. The most common time every single day for a reversal in the market is 10 o'clock. Okay? Because the retail traders have gotten all the positions in, they're happy, they walk away, and then bam, the market goes back against them. Now, the reason I'm telling you that is because guess what time is the best time of day to be able to trade a parabolic retracement? 10 o'clock in the morning, or things like obviously at night with the Aussie because there's nothing else going on. So that's kind of why I brought it up. And again, if you guys don't believe me, again, I always want you guys to verify everything. Go out there, start looking at your charts. Look what happens. Look when the markets reverse. See what time of day it happens. You guys will find it's typically between 10 and 10:30 in the morning. Okay. Now, what I want to show you guys is what happens is because of the news releases and everything else, that's what causes this thing to spike and then retrace, and that's what we're really looking for. That's where that number came at 10 o'clock, that one I showed you guys earlier. Now, which assets could you trade these retracements with? Okay. Now, this one is pretty easy. I mean, there's no big surprises here. If you guys listen to the beginning, what is it going to work with first and foremost? Forex, obviously. I mean, Forex is a 24-hour market. It's a global economy. I mean, it's everywhere. It's easy. And if you guys haven't traded Forex, I know a lot of people, they see Forex and like, I'm going to do Forex. Good. I mean, you're letting other people have money if you don't want to trade it. Again, there's no reason to be ignorant about different asset classes. All it is another vehicle for us to make money, right? I mean, think about it. If you take a trip, you can ride a bike, take a train, take a plane. It's all personal preference. So it's just a different type of an asset class. I like it because there's so many economic news releases that are, again, not U.S. based. I can trade at 9:30 p.m. at night. You're not trading the stock market at 9:30. The U.S. Not trading ES at night. It's just not worth it, right? But currencies is a great place to do it, right? Next one is obviously the indices, okay? I don't know if you guys have been watching the markets lately. There's obviously been a little bit more increased volatility, right? With everything going on, has there been more fear and greed in the markets? Has there been? I mean, think about it. March of this year, right, when everything started coming out about, COVID-19 and things like that, what did the market do? Was there any huge emotional kind of days, you think? Absolutely. There was a lot going on, right? And again, this is why we use a couple different rule sets to make sure that, they are viable for the actual retracement. And again, that entire move was retraced. Where are we now, right? Look at the NQ. We were really, really high. COVID-19 hit, we collapsed, and it was like, oh my gosh, what's happening to the market? This is unbelievable. It's never going to recover. Is it going to zero? And what did we do? We rallied all the way back again, and we had a parabolic retracement back to the top. Okay, so indices obviously provide a lot of opportunity. Now, if you guys are taking notes, here's something that I would also write down as far as notes go. Okay, my favorite way to trade the indices, though, are not necessarily on the dailies with Nadex. They're on the smaller time frames. Okay, and the reason why is because the smaller time frames have smaller strike differentials, and you can really take advantage of the early morning movement before we kind of go into like the afternoon doldrums and stuff. You can also do it at the end of the day as well, but there's not really typically any economic releases then. The ideal kind of sweet spot is those kind of 2 hours, 2 hour binaries in the morning. Those tend to work out the best for the indices. All right, and last but not least, commodities. So yeah, you had some good trading in gold lately. Yeah, absolutely, absolutely. Anytime anybody mentions the word inflation, what do people do? Buy gold, right? Amazing opportunities. What about oil? Okay. Oil has had some absolutely amazing spikes. Again, every single week, we get an oil inventory report, right? Oil is a big factor. With demand going lower, obviously oil's had some problems, but every single day there's been kind of bounces. And again, oil is one of those other ones that is notorious for switching and rolling around at 10:30 in the morning. The oil inventory report, just so you guys know, is at 10:30 typically on Wednesdays. Sometimes it needs to get pushed back into a Thursday timeframe. But again, what are we looking for? We're looking for an emotional response, typically for numbers that miss. Okay. Now, big question is, why would I use an out of the money contract? Now, I'm going to spend a little bit of time on this slide. I had a couple extra ones I was thinking about putting in there. There's a lot of different ways, and when I say out of the money, typically, obviously, there's no such thing as an out of the money, knockout bracket, right? Because that's not how that's not what the rules are, right? I do like to use knockouts for these a lot, but when I mention out of the money, what we're typically talking about is binaries and call spreads. Okay. And there's one reason why we would use an out of the money. One, obviously there's an emotional time. So, there's an emotional kind of situation going on, and we need to be a little bit extra careful when there's extra emotions in the market. But using an out of the money, what are some of the benefits in an out of the money contract? And again, binary or call spread both work. Okay. Being out of the money, is our risk bigger or smaller? Answer is obviously smaller. Okay. Now, there are pros and cons to using it out of the money. One, obviously, it's smaller. Two, obviously, there's, according to the statistics, if it's out of the money, you have less of a chance of doing it. And again, that's why we need kind of an edge, and that's kind of why we use the strategy like this one. If we were using an at the money contract, what are the cons? Well, would we probably be profitable more, more often? Could be, right? I mean, we don't need it to move as much, but if we take a loss, we're losing a whole heck of a lot more in that trade, right? And out of the money, it gives us the ability to do a couple different things. All right. Now remember, we're looking for an explosion in price up about 1.5 times what the average is during that time frame. And what we're looking for is somewhat of a reversal back to the origin of the move, where that thing started, right? Because again, once the emotion is wiped out, we expect it to return back to where it was before. Okay. Big question, and again, I guess this was asked in the last session, is do you take these contracts off early? All right. For me, one of the biggest reasons I like out of the money contracts is, one, if I risk less, do I need the price to move really, really far to be able to make 1 to 2 or 1 to 3 or 1 to 4 risk to reward? I mean, think about it. If I risk, say, $15 in a contract, and I'm looking to have a strategy that I have at least a 1 to 3, and again, it could be 1 to 4, 1 to 5, but if I only risk $15 getting into this contract, and I used a smaller duration, something like a 2 hour, what is the probability that that trade will be, profitable if it starts to reverse? Answer is pretty high. Let me give you an actual fixed example here. Think about, and again, if you guys don't look at the contract specifications inside of Nadex, you're really starting to miss out, okay? With this parabolic retracement strategy, and this is, consider this homework for you guys to be able to take this strategy and make it your own and make it better. Start looking, again, at the 2 hour and below asset products. Okay. Look at some of the 2 hour binaries. Look what the differential is and think about how much does it need to move. Okay. An example being something like the euro dollar on a 2 hour binary, right? It has a 4 pip strike differential. It's very, very small. And inside of that window, typically if we have a retracement, say it surges 40 pips. It will typically retrace 25 to 30 of those in the next hour, typically, hour and a half. You just jump 5 or 6 strike prices inside of that time frame. Is there an option? Is there the ability to use a little bit farther out of the money, risking less? And yeah, here, I'll show it to you real quick. So this is just an example. This was actually, again, I like the way that this is set up because it's very easy to read all the contracts all at one time. Now, this first one up top is with the S&P 500, and you can see what is the strike differential right now, right, in that time period. Look to the left, and you guys can see that it's 0.50, right? So in this case, there's only a little bit of time left. There's about half of the contract's duration left. And again, this is why it's a game of matching the duration to the spike. But think about it, right? The at the money right now is very, very easy to see, right? It's the 3011.25. It's right in the middle. The offer is $50.50. So if I buy it, I'm taking $50.50 worth of risk. If it closes above 3011.25, again, at say 26, right? I end up making, I make the other side of that, the $100, the $49.50. But if it goes down, I lose my 50-50. Now, what if I just jumped it out 2 strike prices? What if, and again, this would be I don't know if you guys can see I don't think you guys can or not. The fourth one down says $13. It's the 3012.25. So it's 1 point higher than where we are at the money. It's only $13. So if I bought that one at $13, and let's just say in the next 8 minutes, again, it's a very emotional time. The markets are moving. What if it moves just 1 point in the next 8 minutes? Could it do that during a very volatile time? Absolutely. It happens all the time. How much is that strike now worth? Well, we know the at the money is going to be about $50, right? So if you're risking $13 and you take it off for 50, what is your risk to reward ratio in that trade? Now you could hold it and get the full, the full $87 worth of profit, and it may go past that during that time frame. But this is just an example on a smaller time, a smaller, duration binary. Now at the bottom, it's a currency trade setup, and you guys can see the same thing. There's an hour and 50 minutes left. Well, that's a 2-hour binary, right? Look at the difference in this one. You can see the at the money, the closest at the money is about $61 to get into it, right? You can buy in, it's right there. But if I lose, I'm only going to get 40 out of it. But look, go 2 strike prices above that. Instead of it being at 70.18, you go too higher, it'll cost you $10.75 to buy that contract. Meaning the only thing that you have on risk is $10.75. And you have the potential to make the opposite of, 1075 minus the 100, right? You're $89.25 over an 8-to-1 risk to reward ratio. Okay. All it has to do in the next hour and 50 minutes, again, the indicative is at 70.19. All it has to do is move 7 pips. Well, what if I told you that the ATR, the average move during this time in a 30-minute chart was 5 pips? Okay. 5 pips is what the average is, but remember, we are playing an emotional response that typically gets retraced. It only needs to move 7, and you've just gone above what the actual strike price is. So this is why I prefer to use out of the money here, and why, for me personally, it makes the most sense. Maybe you're like, hey, listen, I want to get that into, I always get this one, the one detractor that wants to play devil's advocate and says, well, wait a second. I mean, if it's already, 19, it's got an hour to go. I want to spend $88.50 because the win-loss ratio is what matters, right? No, the risk to reward ratio is what matters. Being green at the end of the day is what matters. What would you rather do? Risk 88 and have a chance of going, man, I need to win 10 trades in a row now because I took 1 loss, or risking $10.75. Okay. So a couple things that you guys need to know is, one, how do we know it's not going to go up any higher? And in full transparency, there's a few different ways. There's no such thing as a guarantee that it's about to turn. Okay. There are some confirmation entries that you can use, especially when you're reading charts. Me personally, I'm a supply and demand person. I can't even tell you how many of these trade setups, literally price spikes, it stops and turns around. And people are like, why did it turn right there? And it happens to be a supply and demand zone. Today, I was preparing for this. One of my students actually took a position in oil. And guess what? It was a spike down very, very fast. It slammed right into a zone, which, again, is a strategy that I teach, and turned and flipped all the way back up again and went right to where it was before the move. It's a textbook example, okay? You can use, again, there are people that use this and do this method with support and resistance. And again, there's numerous different strategies, but what I'm trying to teach you is the concept of you're looking for these large explosions in price. And then what you're doing is wherever you're comfortable, what your strategy is to take that reversal, what you're looking to do is take advantage. And again, it's great that Nadex gives us this ability. Figure out the correct vehicle using a smaller duration binary call spread or even a knockout. Again, you can use knockouts for this, but you're going to have to be near the floor or the ceiling. Now, again, I do want to get this in there, okay? When knockouts first came out, I was highly resistant to knockouts, right? And again, they weren't called knockouts, they were called touch brackets back then. And the reason why was, one of the things I like most about Nadex is the fact that, again, if I take one of these binaries and say it whipsaws, right? Say, I do this one at the top where I spend $10.75. Say it goes right against me, right? I can only lose that $10.75. And it can still, again, whip down and then go straight up in the air and end up in profit. Well, in a knockout situation, I really didn't like the idea of the fact that it could whipsaw against me, take me out of the trade, and then still go to where I thought it was going to go to. They used to frustrate the heck out of me. But I gave knockouts more of a chance. Okay. I know my levels are good. I use the levels all the time. I do broadcasts all the time with these levels. One of the things that I like about knockouts is the fact that they are very, very, very in touch with where current price is. Okay. The one thing that I found with knockouts, okay, particularly with this strategy, as the spike happens, it's typically blowing up knockouts. So you need to be able to watch this one. It's a little bit hard to pre-plan because as the price is spiking up or spiking down, it's wiping out knockouts and new ones are getting printed. Okay. What that does for us, though, is it gives us a very close proximity entry, which gives us very low risk. Okay. And if there is a fast retracement back again, that profit target is typically sitting there and it gets stopped out in the other direction for a full profit. So it does, again, there is the con where you're not really protected as much with the whipsaw. But again, remember, the whipsaw's already happened. We're playing the retracement of the whipsaw. So we will have very in touch. Part of the problem with some of these binaries is if the price moves too fast, too much, too fast, there's no binaries even close. We can't get an entry because there's nothing left there to do, right? So that's the one problem. If it's too big an emotional move, we got no binaries and no call spreads to trade. That's where we have to switch over and trade knockouts because, again, they do get reprinted. They are in close proximity. There's nothing more frustrating for me when I see this strategy, or when I try to use this strategy, and I see an explosion in price, and then I go, oh man, I can't wait to trade this. And I go over and look at the binaries, and I'm like, oh my god, it's like 40 pips above, or it's like $40. It's like there's nothing to trade. There's nothing to retrace. Everything's already too high. It's moved too far, too fast. Nadex was never able to keep up with that. The market makers have already made, put all the contracts out and they can't do it. That's where knockouts are really one of those things that is absolutely amazing. Okay. So kind of one of those things. All right. So with that said, 1.5 times is the biggest thing that you guys need to focus on. A lot of people are like, well, how do I know it's going to flip? And again, a lot of this is, you need to have confirmations. I will give you guys a free kind of confirmation tool. Okay. One of the things as a price action trader I do look about opening, closings, highs and lows of candles. And one kind of telltale sign on this, and again, it's a terminology that I use with my students all the time, is a failure to go higher with a confirmation, okay, with a color change. And a very simple, easy to use tool would be when price stops going up and you on a lower time frame, and again, depending on what you're doing your analysis on, most of the analysis and the spikes that I'm talking about are happening on a 30-minute time frame. When you go back to, say, a 5-minute time frame, if the price spikes, one way that you can do this, and again, very simple, there are better ways to do it, but this is one that, is pretty reliable as well. When you get a red, green, red color combination with candles, that's typically a good telltale sign that, hey, listen, it spiked, it pulled back, and it failed to go any higher and is now starting to go low back down again. That typically is a sign, and again, most times that one is able to work. Okay, so that would be the easiest way to find where this retracement is going. Now, whether you're going to use a call spread or a binary or a knockout, that is left up to the individual situation. Unfortunately, this is one of those things where you need to kind of add some spices to yourself. depending on the time of day, depending on what you traded, depending on what the reaction is, if there's binaries left, if there's not, I can't tell you which one is going to be the best right now because I'd have to see the individual situation. But the more you practice this, again, you will get the nuances of using a binary, or using a call spread, or using a knockout with it as well. And people have their favorites. Here's the thing: somebody in this chat right now, you may be an absolutely phenomenal knockout trader. You may be, again, there are always better traders than me out in the world. For anybody to think that they are the best it's being, very egotistical, right? There's probably somebody out here in this group that's a better knockout trader than me. Sure, I'm fine with that. I don't care. Everybody has methods that work for them based off their risk tolerances. Make this your own, guys. I'm totally fine with that. Take this concept that I've given to you guys. I've given you some basic parameters on how to make it your own, whether you use support, support resistance, if you use supply and demand like I use. There's Fibonacci that you can throw into this. That also works very well. There's a number of different ways to be able to, kind of turn this around. Now, big question is, what are the next steps? All right, so first thing first, I mentioned in the very beginning that I was going to give you guys a free tool. So I've actually taken the time, and this is something that I still continue to track myself. It was something that I have done for years, okay? I have a report that I'm going to give you guys absolutely free. It doesn't cost you anything, and it's what I would call my news analysis report, okay? All you'd have to do is go to nadex.keeptradingsimple.com. It's a website. Put it in. I'll email it to you. What I did was I tracked for an entire year all the major economic news releases across the entire globe, okay? And again, it's primarily currency-based, but again, U.S. economic news obviously affects the indices, gold, and oil, right? Could you trade the same setup with individual stocks, with Apple, with Google, with Ford? Yeah, absolutely. You definitely can. But again, what you need to do is you need to go see what the normal move is when there's a missed news release, okay? But what I've done is I've compiled basically the top 8 countries in the world, the ones that have the most power. I've taken all the big ones, right? Like the United States has like 10. This is kind of what it looks like in here. I break down all the 8 major currency pairs. I take the top news events. The United States obviously has the most. And what I do is I talk about what the average percentage time missed is, because right now, guys, if the forecast is 3 and the news comes in, the actual release comes in at 3, there is not an emotional response. There is no big, large explosion in price, right? Hence, there is no parabolic retracement. Move on. Thank you. Come again, right? Go outside and have some fun. There are certain releases that are even higher. They go up in the 70s, 80s, 90s, and 100s, right? Sometimes they almost never miss. I don't know if you guys have ever looked at oil. I don't know who does forecasting for oil, but they're right like twice a year. That's it. Out of like 52 releases, 2 of them a year are right. Well, I've broken these all down for you, and what it does is it gives you the daily ATR, the 4-hour ATR, and then the 30-minute average response to missed news, okay? Knowing that something is going to, in this case, you can see that the pound dollar, the average 30, the 30-minute average response is 36 pips, but then you look over at the 2-hour Nadex binary and say, hey, wait a second, the strike differential is only 4. Heck, that's almost 10 strike prices worth of movement. There's out of the money. This is an out of the money setup. Absolutely. That's kind of what I'm getting at. So you guys can head over there and get this again, this is a free download for you guys. I compiled everything for a year. Now it does the analysis ends at the end of August last year. I did not update it this year because is a pandemic a normal occurrence? No, obviously not. It's not, right? So this is going to give you what the average looks like. Okay. Obviously, during March, this time frame, March of this year, when everything was going crazy, these numbers would not necessarily have been accurate. But again, you do need to adjust, but you guys can kind of see where the analysis is. And again, understanding what normal is, we're pretty much back to normal in our moves right now. I know the pandemic is still here, but the markets are fundamentally reacting just like they were at this time last year. But again, obviously, keep your ears down, listen for, you got to learn how to use ATR is kind of what I'm getting at. All right. Now, some of you say this is great. I want more specifics. Give me everything else. And again, this is kind of, this is, no pressure for anything for you guys. If you do want more about parabolic retracements, specific rules, the way that I'm using supply and demand, the best news releases that I personally are trading, there is a class associated with it. And again, this is up to you guys. What it does is it basically gives you everything you need to know about parabolic retracements. I'm giving you the tool in there. There's 6 lessons included, terminology, really defining retracements. And there are some retracements you do not want to trade. There are rules for it that I would, again, if there's a fundamental change in the market, it's not going to retrace. So I break that down. And I also talk about using it with Nadex, but also using it in the currencies market, because a lot of people out there, if you're a Nadex trader, you typically know how to trade Forex as well. And then I talk about what news matters the most. As I said, there are 10 news releases in the United States. If you want the highest quality one, that's where I kind of break down. Now, with that, I also give you guys a Parabolic scanner. Okay, this is for MT4, and I actually have it for MT5 as well for any of you guys that are out there that are currencies traders. I use it a lot. It kind of sends an alert to my desktop, and that's a lot of times what happens is if I miss, say, like an Australian news release because I'm out doing something with my sons, I'll get an alert. It emails my phone, and then I need to just run back and I'll place a trade. I also give you guys a cheat sheet with reversal confirmation patterns. That's that red, green, red, and the green, red, green that I talked about before, as well as a trading journal. Now, you guys have most of the rules inside of this presentation, so this is just kind of further kind of diving into what that reversal pattern looks like. You obviously, I'm giving you the access to the news analysis report, as well as I'll give you guys a forum if you guys want to talk about it with other traders. Most of my more experienced guys, we don't get in there and talk about it as much, but we're always willing to help new people. So the way that you would find this is over at, retrace.keeptradingsimple.com. They posted the link inside of chat. But all it does is really, guys, this class will expand further upon what we've already covered. If you guys get into it, if you guys have gone to the webpage, you see it's $149. And again, continuing support for it is always free as well. So I know I got a couple minutes left here, about 8. Rolly, I didn't look at the questions panel. I was only looking at chat. So is there anything that came through that you want me to answer that was in there?
Well, yeah, Brian, there are several questions that came through your presentation, which was excellent, by the way. Sometimes I feel like an hour is constraining when there's so much.
It was hard.
But,
always hard.
But so let me kind of distill this down a little bit. One of the things that I noticed here was so in your strategy, trading these parabolic retracements, are you primarily placing your trades on Nadex, or are you also placing trades using parabolic retracements, for example, on a Forex trading account?
For everything. Yeah, for everything. Yeah, I use it a lot. So typically, depending on the time of day is when I'll use it inside of Nadex or inside of Forex. A lot of times for early morning releases, again, I do my analysis over multiple time frames. So for me, the 4-hour time frame is kind of my absolute law. It's like the rock, right? During the day, during news, if we bounce around and say it runs into, say, like a 30-minute supply or demand zone for me, then I typically tend to look back and I'll look. And again, just like all news releases are not equal, all Nadex contracts are not equal as well.
Sure.
Sometimes there's too much premium baked into them. The market makers make them a little bit crazy. Sometimes, and again, I understand why, Nadex has to change the strike differentials based off the volatility in the market. So there was examples this year where, say, the dollar CAD or the Aussie dollar CAD is the best one. The strike differential, even on the smallest of time frames, was like 20 pips. Wow. It was way too much for that time frame. There was no way that I was confident in saying, hey, listen, this is going to retrace far back enough. I would have had to risk or have the position too far out. That's a scenario where I would much just rather trade it over in currencies. And again, it's kind of the same idea. I mean, I use stop losses on everything that I do. But it doesn't necessarily matter. Like I said, it's one of those things that it's a fundamental kind of reaction in the market based off of human emotions. Sure. So you can trade it in Nadex. I just like Nadex because I love having that, and just options in general. I absolutely love having that absolute maximum loss going into the trade. I mean, even currencies with a stop loss, that doesn't guarantee that you're only getting out for that loss. If there's
that's true. I mean, we've all experienced, I think you said, how the market can whip you out of a stop loss and then continue on with an impressive direction, and you're sitting there with nothing.
And that's the thing with options. Whatever you get in, it doesn't matter if it whips back or doesn't. I mean, you're protected. Again, slippage always comes up, right? Except when you have something like an option.
And it brings up a question in my mind, and this is maybe what some other traders are thinking. I don't think anybody's advocating here that you should stop what you're trading and focus only on Nadex, but I'm just wondering, Nadex strikes me that it might be a good hedging strategy as well.
Yeah, it is. And that's kind of the thing too. I am a full believer. A lot of traders come to me and they say, yeah, I have this strategy that I've been doing and I'm making a little bit of money. And the first thing I always tell them is don't stop doing what you're doing. You can always add something else different. And again, just like, I mean, in everything, I mean, small business owners, they always have multiple hats that they wear. And as a trader, you should do the same thing. I'm never telling people, hey, you should only trade currencies or you should only trade Nadex. You should know how to trade all of them. I mean, there are times of the year where currencies are flat and don't move. There's days that oil doesn't move at all. There's days that, the stock market does almost nothing. you got to have multiple things. I mean, if trading is your goal or your career aspiration, you got to have more than just, you just can't be a one-trick pony. You have to be able to trade multiple things. And when I found Nadex, I mean, I was already trading other things and was able to make a living off of it. But all it did was give me even more options to be able to kind of trade different things. And again, maybe today I'm not feeling currencies, or, you know, I really like the risk to reward ratio that's set up on some of the out of monies. I mean, you have to be flexible in your trading. So I always advocate that, you know, you should be able to trade multiple assets.
Yeah, that's an excellent point, and I think that's good advice for everybody. And one of the key takeaways from this session is that, you know, as you've seen, their trading platforms are available. We got excellent, you know, traders right here sharing techniques that you can test and see if it's a way or a good way to simplify your trading and diversify. I see a questions come in here. This gets back to your point that you made about, you know, optimum times to trade during the day. And the question was, did you say that 9:30 Eastern time was a good time to trade?
No.
I didn't think
9:30 is
so.
the open, is basically a time for retail traders to try to react to what they've heard in the morning. What I would do, and what I feel is a safer play, is to trade against kind of the average retail trader. Wait till 10:30. And whoever asked that question, I would challenge you to go out and look at some of your charts. And again, go to like the 30-minute time frame. And I don't care what it doesn't matter what you're looking at. Go back and look at the indices. Go, you know, over the last week and a half. Look at oil, look at gold, and look what happens with price action from 9:30 in the morning till 10:30. And look when price changes. Like a lot of times the other day, we saw oil moving down from about 6:30 in the morning through the open. Everyone's like, oh, it's going to be negative. Look, it was open pre-market and moving beyond. And then all of a sudden at 10 o'clock, it turned and it ended up the day, you know, up higher, much higher. So it's a very common thing that people think, oh, I got to trade the open. But what it is the open is nothing but a reactionary time period for people to say, hey, at 8:30, they said this. And, you know, this rated this, you know, this CNBC said this, and this person said this, and MSNBC said this, and I saw this in the Washington Post. All it is a reactionary time period
That's
that,
true.
again, it's meant to prey on retail traders. And you got to think about this like big business. You know, your goal in trading is not to trade against Goldman Sachs and hedge funds. Your goal is to trade against the person who is less educated than you, stack the odds in your favor, and figure out how to take money from people that aren't educated, that don't know what they're doing, because they're just going to go in there and just, you know, try to use gut feelings and emotions and hunches. And that's not what trading's about. You know, this needs to be an ironed out kind of, you know, you need to have a plan that you follow every day, a rule-based system. And that's what I always advocate with traders.
Absolutely. And Brian, unfortunately, we've come to the end of our time here, but you gave us all a great presentation.